Hi all, and welcome back to the ICIS Energy Foresight podcast, the podcast that looks at the future of the energy market. I'm Matteo Mazzoni, and I'm here today with Maggie Jones to talk about the power outlook for this summer. Hi Matt, how are you?
Thank you. How are you?
Very good. Very excited to this conversation. Last year, exactly a year ago, we were in the midst of one of the major energy crises of the past 40 years, 50 years probably. And the European power market was heavily impacted by a series of policy measures. I remember the inframarginal price cap basically tried to tackle a few technologies, mainly renewables. There were targets on trying to reduce electricity demand, and at the same time there was this cold topper in the Iberian market. This year it looks quite different. We're probably in an opposite environment or something like that. Last weekend we recorded the all-time low for power prices in Europe, where in Germany and Netherlands the price of the electricity on the day ahead hits minus 500 euro per megawatt hour. So what's the policy landscape for this summer, Matt? How is it different from last year?
Yeah, so I mean, most of the measures that were introduced last year are now become largely redundant because of the massive fall in prices that we've seen. So you take German month-ahead prices at the peak in August last year, they were 470 euros per megawatt hour. Whereas for the last couple of months, they've been under 100. So we're not too far off, normal style pricing as it's been for the last few years pre-crisis. And that means that there isn't really a need for these measures that were brought in to protect consumers last year. So the demand targets went at the end of March, the inframarginal price cap went at the end of June, and the only thing left is really the Iberian exception, though even that's not having an impact because gas prices are so far below the cap anyway. So I wouldn't expect to see any of these kind of measures reintroduced unless we got into a position where prices were massively increasing as we head into the winter.
So effectively, we can say that the market is back to normal functionality, so to work as it probably should without any major policy interventions. And usually during the summer, the events or the factors that have a major impact on the market are temperatures and the power demand, obviously associated with it. But I get from your point that we are still, in terms of prices, well above average or well above historical average. So do you see any let's say trend unfolding? Are temperatures actually driving up demand on prices, or prices are still too high to have any sensible impact in terms of demand rebound?
Yeah, I mean, I think the most interesting trend is in that power demand and what we've seen so far this year, right? So for the first half of the year, we're 6% down compared to the first half of last year. And what's particularly interesting is that it's not a winter phenomenon. So it wasn't, we saw demand reduced a lot at the start of the year because of high prices and now starting to recover. Instead, since February, we've had pretty much 5% demand reduction every month. So we're not really seeing any resurgence of demand. We've done some analysis trying to pull out what's the weather impact of that based on heating degree days, cooling degree days. And it suggests that the weather is responsible for about 20% of the effect, but that leaves 80% that's really price-related demand destruction. So the really interesting trend to watch is what happens with demand going forward. Obviously, if there is a heat wave, then that could push demand back up, which is something that we saw in July last year. But if you look at the non-weather-driven demand, that's really the key. And I think there's an open question on, are we just seeing a delay to the declining prices, in which case demand should really start bouncing back in the second half of the year as prices continue to fall? Or are we seeing some kind of structural changes to industry and to residential behavior that means that you've got some kind of permanent demand destruction? I think the jury's still out on that. But the more months that go by without seeing any kind of resurgence in demand, the more suggestion there'll be that there is that permanent demand destruction, which is having a bearish impact on prices.
Okay, so effectively, let's say our projections, they show that there is not, let's say, a rebound in demand is not likely to happen over the next weeks or so, unless a massive heat wave hit Europe. But on the supply side, how are we doing that? Because over the past years, the main source of uncertainty has been French nuclear availability, which from what we see at the moment is still a major source of uncertainty. Do we see any, let's say, price spreads, for example, between France and Germany, any factor that market players are overplaying or underplaying at the moment?
Yeah, sure. So, I think the main development in France is for those winter products, we're seeing massively inflated prices and overvaluation of them. So our Power Foresight modeling suggests that the Q4 contract in France is overvalued by about a third, and the Q1 contract for next year by more than 50%. So that's huge risk premium that's gone into those contracts over the past few months, really since the start of March, when you got news of those new reactor cracks being found. And what's interesting is that the connected countries haven't followed France up in terms of the risk premium. So that means that the spreads to those connected markets have got larger. Now, this is exactly what happened in the first half of last year, where the connected countries didn't follow France up until the second half of the year, when suddenly traders got nervous about supply in France. And then you saw GB, German prices starting to have risk premium put on them. So it'd be interesting to see if we see the trend being the same this year. But I suspect that we actually won't. I think in the absence of further major announcements of nuclear problems in France, it's more likely that you see a sell-off, and therefore the French price declining, spreads to those connected markets declining as well, because the fundamentals just don't justify the price that we're seeing in France at the moment.
So all in all, can we say that the summer outlook looks more bearish than bullish?
I think it's continuing to look quite bearish, particularly, the gas side as well, which we haven't talked about, that there's the storage levels keep being filled up. So in the absence of some big event that pushes prices back up, I think we're looking at a continued bearish trend.
Thanks a lot, Matt. Let's see what the summer orders for us. And thanks all for watching. If you want to know more and be on top of what's coming, please visit our website or simply use the QR code that you see now appearing. Till the next time.